Barron's does a list every year, have been doing it for years, on the 100 most influential women in finance. And in every year that they publish that list, Lizanne has been a member of that. So great kudos to her. And then additionally, Investment Advisor, another publication, does a list of the 25 most important people in and around the financial advisory profession. And Lizanne is on that list as well. So a true celebrity in our industry. Thank you. Well, let me tell you what I was bridging with for a couple minutes, because I think you made these comments as well. I tried to tie together K-shaped economy with consumer sentiment, and just meld those two ideas together, and that maybe that it's not exactly K-shaped. That both lines are increasing, but that lower leg of the K, obviously at a much more gradual slope of income gains and versus inflation losses for a certain sector of the economy. But I would love for you to just pick up there and add some of your thoughts, because I know you have many around, consumer sentiment versus the stock market, and how we feel versus how business is doing, if you wouldn't mind.
Right. Sure. So I think to your point, Chris, I think that the K is alive and well, and there is a bit more relative pain down the income spectrum, because even though wage growth differentials have narrowed significantly, the rub for lower income people is that their real wage gains are actually slightly in negative territory. And that's because at the lower end of the income spectrum, they spend a disproportionate share of their take home on non-discretionary items. And if you look within the CPI or the PCE, and instead of breaking it into core versus headline, which is the common way to break out inflation data, break it into discretionary versus non-discretionary components, it's the non-discretionary components that still have a higher inflation rate than the discretionary. So it's sort of the needs versus wants components of inflation, and the needs are running hotter than the wants. So you're taking a larger chunk out of wage gains at that lower end. So that's part of the K. But another place where you see a K, just as it relates to divergence, to your point in the latter part of the question, is there's such a significant difference in this cycle between the soft economic data, to your point, the survey data, consumer confidence, consumer sentiment, and the actual hard economic data. So it's often been termed, the vibe-pression or the vibe session. There's just a more negative vibe than what is borne out in the data. And there's, I think, lots of reasons for that, which we can get into, but that's the tie-in between the two parts of your question.
So I'm going to continue with that question for a second, because you offered it up. What do you think are some of those, and the picture in my head right now is maybe University of Michigan survey, but over a 50-year history, how is it that we feel so much differently as a society today than we did 10 and 20 and 40 years ago?
Inflation. And inflation also explains why there has been a divergence between University of Michigan's consumer sentiment reading and the Conference Board's consumer confidence reading. On the surface, it seems like they're basically asking similar questions. It's a reading of the confidence or sentiment, again, depending on the title of the index used. But the nature of the questions asked by University of Michigan back 70 years gears more toward inflation. So the answers are driven more by perceptions around inflation. Consumer confidence, which did not hit record lows like consumer sentiment did, the Conference Board questions that they asked tend to be a little bit more geared toward the labor market. The labor market has stayed in relatively healthy shape, yet inflation has been the bugaboo. So that not only explains why sentiment is much weaker, but why sentiment has diverged from confidence if you use those two formal measures of how the consumer is feeling.
Yeah, that's a great split between those two, and it's like somewhere in the middle of those two whether that household is going to go buy a new Ford F-150 or not is probably in
Right.
that, do I have a job? And then how do I feel about it? So that's,
Right.
those are great comments.
And speaking of buying a Ford F-150, the most visceral component of inflation for consumers is gasoline prices. It's
Mhm.
that you know number we see every single day, and for a lot of people, that's the inflation rate. You and I might live in the weeds of CPI versus PPI versus PCE and core versus headline and month over month readings and year over year, but consumers generally think of inflation as what am I paying for stuff now relative to what I used to pay for stuff? And
Yeah.
probably the most visceral among that category of stuff is filling up our cars.
Yeah. Yeah. Very volatile. And it's just like, how much does the grocery store cost and how much does it cost to get there? That's what people
Yep,
are going to pay attention to.
that's right.
So let me shift gears a little bit. You've been doing, and I personally appreciate this. Everyone should. You've been doing commercials lately on, I see them especially on CNBC around, you know, gambling is not investing or betting is not investing. And so the way I was going to form that question or ask you to ponder that was, we sort of had the gamification of investing a few years back where, the confetti went off if you bought an
Hmm.
ETF or a share of stock or something, and that was part of it. But now we're sort of seeing this, air quotes, you can't see me, but investification of things that aren't really investments.
That's right.
Is the ship in Hormuz going to go this way or that way? Is this going to happen or not going to happen? Are those two things for you nearly the same, or and where do you see it going from here for the next few years?
Yeah, so let me start actually with a kind of a fun anecdote with regard to the commercials that have been running. That was not me doing a commercial. The genesis of that was I wrote a piece back in April that's still on Schwab.com. Anybody can access it. It's called Gambler's Blues, and it was
Hmm.
a long form piece looking at the blurring of the lines between investing and gambling. And I'll go into that in a minute. But the fun anecdotal part of the story was Chuck Schwab himself texted me within a couple of days after that published. I don't remember when, but that doesn't matter. And just texted and said, um, that was one of the best things you've ever written. And he added to the text, even though these days everything's supposed to be done by email, but he's Chuck Schwab and he texted, so that's okay. He added to the text exchange Jonathan Craig, who's head of retail, and Rick Worster, our CEO, as you know, and said we should make this into a commercial. So that's what they did. So they took a clip from a video that I did, a short video on the subject, and then had me. The voiceover was me from that video clip, the words which came from this written report called Gambler's Blues. So the net of it is there has been a blurring of the lines, and that's somewhat due to the marketing of many of these platforms, sports betting platforms, prediction markets, suggesting to their constituents that this is another form of investing. And a lot of
Exactly.
survey data, we looked at a Harris poll, there have been other surveys done, particularly of the younger generation, that not only tend to conflate the two, but they actually think gambling is akin to investing and that it's an important part of their long-term planning. And the problem is that, and what I wanted to differentiate in the piece was, in very simple terms, investing is about owning. You are a participant in wealth creation. You're taking ownership in the future cash flows of a company, as a for instance. You are taking an investment in capitalism itself. If you're betting, you're not owning, you're hoping. And you're not a participant, you're a spectator. You make a bet, you step back, you hope for a windfall. More likely than not, you're going to lose everything. So that distinction needs to be made clear, especially to younger people who are conflating the two. And our conclusion at the end was that this has the potential to be a financial literacy crisis because there's too much of a blurring of those lines.
Yep. Well, again, we thank you for um, putting a face to that and continuing to push on that. I think we're doing, I hope, a very good job within our firm of 40 people of communicating that and advocating for that literacy. But it's sometimes it feels like you're swimming against a really big tide. So
Yes.
keep it up. We appreciate that. So maybe from here, Liz Ann, if you don't mind, back up to bigger picture in terms of
Sure.
whatever, and however you want to paint it. So I'll do a broad question and you can take it from there. But economy overall, stock market overall, and then how you maybe parse that to say, yeah, this is good, this is bad. It all adds up to pretty decent. But how are you explaining that bigger picture to people right now?
Sure. So I think the economy overall is in pretty decent shape. There was concern that started to brew when second quarter GDP was reported because it was weaker than expected. But there's an interesting reason behind, or part of the reason behind, why GDP was weaker than expected that I think is not well understood, or maybe not even known. So the way GDP is calculated, there's a trade component that nets out imports and exports. Not only do we as a country import more than we export, but a good part of the massive AI spending boom, which has boosted the business investment component of GDP, that's absolutely booming, double-digit growth. Yet, in the build out of AI, what is being purchased from that CapEx standpoint, more of it is imports. And we don't have the commensurate strength in exports to offset that. So the simple math is, if we're importing more than we're exporting, it accrues to the disadvantage of GDP. It acts as a drag on GDP, even though business investment is booming. So that's a piece of it. Thinking a little bit more long term, we are in a very unique cycle and have been in the aftermath of the start of the pandemic. And it's one that has not been linear. We haven't had this backdrop where we had the COVID related recession, we rebounded out of that, you go into an expansion phase, and you go into a late cycle phase, and you go into a slowdown phase, and then you get the next recession. That's the linear typical cycle. But that tends to happen when things are moving in the aggregate. That's not happening right now. And not that we want to rehash the last 6 years, but it's instructive to go back to the pandemic when everything was shut down, then the stimulus kicked in. The only thing we could spend that stimulus money on was the goods side of the economy, because the services side of the economy was completely shut down. So the goods side of the economy ramped up, manufacturing ramped up to support that, yet we continued to be in a services recession. Then manufacturing started to roll over at the same time vaccines were created, allowing for a reopening of the global economy. And there was then massive pent up demand for the services side of the economy, and there was pent down demand on the goods side of the economy. We then went into a goods slash manufacturing recession from which we only just pulled out earlier this year. All the while manufacturing was in a recession, services were booming. Now we've got manufacturing picking up, but services is starting to soften a bit. So it's these rolling sectoral recessions and rolling expansions where different pockets of the economy are doing well or doing less well at the same time. And that ties into the kind of stock market behavior we're seeing, particularly in the last year or so, which is very, very rotational. Not these monolithic leadership narratives anymore, whether it's the Mag 7 or whether it's just tech more broadly. We see this roll through in a little bit more rapid a fashion than what we're seeing happen in the economy, but that's where the dots are connected. We have this rotational nature to the economy, and that is somewhat tied to the rotational nature of what's happening in the stock market. And feel free to pull on any of those threads if I didn't provide enough detail.
No, I think that's a great level of detail, and I know in a pretty recent podcast you talked about rolling rather than aggregate recession, expansion. So is the result of that we don't, had to answer this question on a investment committee call this morning. Does that keep us from doing an 08, 09 again, where it's everything everywhere all at once again, and it'll be more of these pockets of good and bad, but you can keep an economy afloat rather than tanking the whole thing?
I think the more benign scenario is more likely than an '08 scenario, but I wouldn't suggest that we've ruled out traditional recessions. Now, '08, late '07 to early '09 was an epic collapse in the global financial system because of a massive bubble within the financial system started in the mortgage market. I don't foresee any of that happening near term. There aren't those dislocations. Leverage is not as high as it was. But the more generally typical cause of a recession is either inflation heats up or growth overheats, such that the Fed has to step in. They have to aggressively tighten monetary policy, and that brings on a recession. Another reason, and sometimes it's related, you get a credit crunch, and that drives. So I wouldn't rule out a more traditional recession, but even then, leaving the '08 global financial crisis kind of epic decline aside, and then if you were to ask an actual aggregate recession versus a continuation of the rolling recessions, I think the latter is more likely, absent a more extreme move in whether it's bond yields or short-term interest rates.
Yep,
We're
that's
living
fair.
a little bit of that in the last month, obviously.
Right.
I don't view it to be at an extreme yet that is really problematic for either the economy or the equity market, but it's something we should be paying attention to because of that recent breakout on the upside to bond yields.
Right. Well, and let's go there next, because then you can make a comment maybe on government debt. But I think this was right before you got on the phone today. We were talking about government debt issuance, hyperscaler debt issuance. Somebody has to pick up all this, an investor side, somebody has to pick up all that debt. That slight uptick in interest rates that you mentioned here, how far does that have to get stretched before you start to see some of those cracks in areas of the economy, or something more systemic comes out of that?
Um, in a very, very small way, we're starting to see the impact. We've seen recent pressure again, notwithstanding a stronger day today, in what would be considered the long duration segments of the equity market, like tech and like communication services, where they're the cash flows are further out. You also have the interest sensitive segments of the market, like utilities, like real estate. Those are the two worst performing sectors over this most recent period of a breakout on the upside in yields. That's not anything terribly dramatic. That's a natural thing to happen. You see a hit to longer duration segments of the equity market because the cost of financing goes up. You see it on the interest sensitive areas because investors can now get higher yields in relatively safe treasuries as opposed to having to venture into the equity market for that income. So all of that is already happening. It's hard to say what would be either the level or the rate of change that would trigger something more significant. So far, I'd say the move up in yields is relatively orderly. It is not rapid fire. It's not with a tremendous amount of volatility. The yield curve has steepened. That's to the benefit of the financial system, but it could get a little bit more out of hand. We could have an experience like we did 15 months ago in the aftermath and the lead-in, frankly, to the Liberation Day tariff announcements. We kind of had a little bit of a riot in the bond market, in the equity market, and in the currency market. So that could repeat itself. To judge, when that would happen, or if there's some level in yields that is the trigger there, it's hard to say. That said, there is a lot of paper out there that's being issued, both on the corporate side and on the government side, in order to finance the deficit and debt in the case of the public sector in order to finance the AI build out because cash flows aren't sufficient anymore to finance that. So all else equal, that puts upward pressure on the term premium, the yield you will accept for the risk associated with going out the duration spectrum. So we're seeing shades of it right now. Nothing calamitous by any means, but there's a reason why this is the big topic right now. It needs to be on everybody's radar screen because we need to understand the connection between what happens with interest rates, what happens with bond yields into the economy and into the stock market.
So you didn't say it expressly, but do you put private credit into that same list of debt issuance then, and maybe watch list in the same way you described it?
Yes, I would. I think, and maybe it was Jamie Dimon kind of hedging himself, or maybe my comment about what Jamie Dimon said is hedging myself. But it was when we first started to see some of the eruptions with Blue Owl, et cetera, and the private credit. He made the comment, and anytime, Jamie Dimon is like the what was it when E.F. Hutton talks, everybody listens.
Yeah,
It should now
exactly.
be when
That's a good
Jamie
word.
Dimon talks, everybody listens. He's the modern day version of E.F. Hutton. And
Very
he
true.
said,
Very true.
when there's one cockroach, there's more. And I think that that's probably correct. But there's a yawning gap between there's more cockroaches and a systemic crisis akin to 2008. I already mentioned, I don't think we're going to get to that extreme, and I would add private credit into that. The thing to watch is the feeder through to public market credit spreads. And we're still seeing them fairly tight, but that tends to be the mechanism through which it starts to really bite in the economy in terms of credit access, ability to pay, and into the equity market. So far, so good.
Yeah. Well, let's go half circle on that argument then to Lizanne about, all right, where's all that money going that's getting borrowed, and go back to maybe the AI trade in total, but data center build out,
Mhm.
importing of those for importing for business spending. And I think we all probably know some plumbers and electricians that could work 7 days a week right now on maybe data center work if they really wanted
Absolutely.
to do it. That's where that spending is going. Healthy contributor to the economy long term, or any worrisome there?
I think long term it will continue to be a healthy contributor. The worry is whether the expectations bar around the return on invested capital, the circularity of financing, margins, the benefits that accrue to productivity, et cetera, whether we get to a point where the expectations bar gets set too high. And it is akin, there's so many differences between the boom in AI relative to the boom in the internet and the spending associated with that. Maybe one of the most important is that the telecom build out, which was the engine of support for the internet, in that environment in the late 90s, it was a build it and they will come. The demand wasn't really there. The investments were driven by the expected future demand. And we now certainly know with the benefit of hindsight that there was a big mismatch there. That didn't mean the internet wasn't a transformative technology. It certainly was. You just got the market out over its skis in terms of expectations for including at the base level profits. That's not the case this time. The demand is insatiable at this stage, and the spending is still undershooting the demand. The question is whether you see the demand part of the equation shift a little bit. This is purely anecdotal, but I had a conversation not all that long ago with Rick, our CEO, about some of the rationalization that us and just about any company out there is doing right now on the spend associated with AI. Where are the benefits? What's the productivity associated with that? Where we might find that the cost of human capital is actually not high relative to the cost of some of this AI build out. And everybody is in that all right, let's assess what we're doing here. Let's assess the spend now. Every company, large and small, if they aren't, they should be going through that right now. So I think the earnings story also, which has been an absolute parabolic surge, unlike anything we have seen other than two periods historically, coming out of the COVID recession and coming out of the global financial crisis. The emphasis should be on the coming out of those two periods. The reason why you got parabolic increase in earnings growth in those two periods had a lot to do with just simply the base effects. You had this unbelievable depression that occurred in earnings because of the GFC, because of COVID. So the math worked to the benefit of the growth rate coming off of those low bases for earnings. That's not the case this time. Last year's earnings growth was incredibly strong. And now we've got this parabolic move in an environment where we're not coming out of a downturn. That establishes the risk that the expectations bar gets set a bit too high, and that we might have to continue to go through this rationalization process that could at some point, probably not imminently, sort of ratchet down some of those loftiest expectations.
Yep. So as you're going through that, I'll make a quick picture analogy, but where this is going to go is stock market concentration. So you can start to think about the answer I know you have there, not individual names, but just maybe categories. But in this particular case versus the telecom build out in the early or the early 2000s that fell apart, is this seems like the horse is actually in front of the cart. These big the now funding the hyperscale were already making money. It was the Microsofts and it was the Metas, and they had great, and Nvidia obviously is a great benefactor contributor to this, but they already had the huge free cash flow that then they were spinning back around to create more compute and create more demand. So here's my question. They were the ones that could afford it because they had the free cash flow or the debt capacity to be able to do these things. And so when that was rewarded at 4 trillion or $5 trillion of market cap, I would have said 50% ago that was too concentrated in a handful of companies. But what's your thought on like just capital market concentration in a few names?
I worry about it less in the stock market because you have less concentration than you've had as recently as last year. I worry a little bit more in terms of the concentration within earnings growth. So, Nvidia alone, its earnings accounts for 18% of the overall S&P earnings. If you're looking at expectations for 2026 over 2025, you add Micron to that, which is another 14%, you're up to 32% of the expected earnings growth jump this year relative to last year is just from two semiconductor stocks. If you look at the top 10 stocks in terms of their earnings growth, it accounts for about 65% of S&P earnings growth. Concentration is significant, less so in the stock market. Here's an example. So I kind of coined this newer cohort of names, the Neural 9, which is all of the 7 stocks in the Mag 7 plus Micron and Broadcom. And so that's the Neural 9, the big, tech, AI, and adjacent space. If you look at contribution rank, which is not just price performance rank, it's contribution rank. So it's price performance multiplied by the capitalization side in a cap weighted index, that gives you the contribution rank. Micron is the #1 contributor to S&P returns. Meta and Tesla are dead last, second to last, and dead last. They're the 503rd and 504th ranked stocks contribution-wise in the S&P. The reason why it's more than 500, by the way, is both Alphabet and Berkshire Hathaway have 2 classes of of shares. So you get more than 500 names, but dead last for Meta and Tesla, #1 for Micron, and everything in between. From a price performance perspective, you go from Micron up 230% year to date, down to Tesla down 25% year to date. This is not a monolith anymore. And part of it is that investors are realizing and looking for opportunities outside of just that small list, from a list perspective, small number of names. small cap stocks are outperforming the S&P. The Russell 2000 is outperforming the S&P by about 10 percentage points this year.
Right.
Very much an AI theme there too. Industrials are doing well. Very much an AI theme there. So the AI story is a much bigger story than just the hyperscalers or the Mag 7. But the concentration is still something we need to be mindful of in terms of earnings growth drivers.
Well, and a great reminder to make sure you fish in all waters and don't get too
That's right.
enamored with one headline group of names that it'll come back to get you. I'm thinking Nifty 50 right now, a little bit
Sure.
to some degree. So, a little bit of a history lesson here at the same time that you talk about the current, but great moderation versus your words, more temperamental era,
Yes.
and what, just put a little definition around those two, and then how
Sure.
you mean that economically.
Sure. So the Great Moderation era, Ben Bernanke, former Fed chair, coined the term, and different people started at different periods of time, depending on whether you're looking at inflation data or interest rates or globalization trends. But from the perspective that I'm going to talk about, it went from the very late 1990s up until the beginning of 2022. The beginning of 2022 representing the point after which inflation really, picked up because of the supply shocks associated with the pandemic. And that was an era driven by massive globalization, a huge energy boom, China joining the WTO in 2001, very little inflation volatility, generally a disinflationary trend, which meant you had less interest rate volatility, less monetary policy uncertainty, and you were generally in a lower interest rate environment. The most important component of what was going on in that environment as it relates to investors is that bond yields and stock prices were positively correlated, with the exception of a period during the global financial crisis when oil prices spiked. But leaving that aside, most of the time they moved in tandem. And that was because bond yields were keying off the growth, the economic growth side of the equation, less so off the inflation side of the equation. So if the yields are going up because economic growth is improving without the attendant concern about or risk of inflation, that's great for the equity market and vice versa. Well, go back to the 30 plus years from the mid 60s to the late 90s. That was a period of more inflation volatility. That's not the same thing as saying inflation was high and just stayed high for 30 plus years, but much more inflation volatility, more supply shock as a driver of that inflation volatility, more monetary policy uncertainty, less globalization, all tied together meant in that backdrop for more than 30 years, with very few exceptions, bond yields and stock prices moved in the opposite direction because bond yields were keying more off inflation, not growth. So if bond yields were going up because inflation had reared its ugly head again, not necessarily because you got stronger growth, negative for the equity market and vice versa. So that's the most important difference for investors, is that relationship between bond yields and stock prices. And as a reminder, bond prices and bond yields move in the opposite direction. So the temperamental era was an era where traditional simple diversification stocks and bonds worked pretty well, because when bond prices were going up, stock prices were going down and vice versa. So that's your sort of typical 60-40 or 60-30-10 works well. Great Moderation era was one where, because yields and prices were aligned, bond prices and stock prices went in the same direction. So that meant diversification was a little bit more difficult. And that's just the nature of the two eras. I think we're now in an environment where bond yields and stock prices are negatively correlated again, which means prices are moving in the same direction, which means we have to be, maybe I would argue, a little more creative when it comes to diversification and how we get it, because it's not as simple as just locking into, a 60-40 simple portfolio.
Do you want to expand on that a little bit in terms of more creative?
Yeah. So, and by the way, none of this is to say that equity investors shouldn't also have exposure to bonds as a diversifier. They do still represent a portion of the portfolio that tends to be less volatile. It generates income. If you're holding to maturity, you get your principal back and you get to earn the income along the way. So there's nothing wrong with bonds. It's just somebody who maybe is trading bonds based on price is probably going to have more volatility and needs to consider that. But it's also the case that the timing is not bad of this shift in correlation having occurred, because our ability to diversify into other asset classes in other ways has never been more democratized than it is today, whether it's in the commodity space or real estate or precious metals or in private credit or in private equity or in venture. So there's just been a level of expansion into the asset classes and the ease with which we can get exposure at a low cost that I think falls at a beneficial time, given what I think could be a secular change in the relationship between stocks and bonds.
Yeah, if those bonds are, that duration's matched to a liability duration or a spending duration, then that's a useful part of the portfolio, right? And it
Correct,
seems like
absolutely.
in that era that you're talking about, there's some kind of weighted average for how important inflation was in each of those, those 3 periods of time. So it's the 60s and the 70s, it was the primary factor. Then you go through the moderation and it's not really talked about, so everything can basically perform more relatively. And now we're back to talking about inflation again, and have been for
Correct.
for the last 5 years. So it's that seems to be that common denominator that we're trying to get out of. So this is probably isn't a fair question, but given the reaction in markets today, would you want to be Fed chair? Would you want Kevin Warsh's job now in trying to utilize interest rates as a way to squeeze out inflation? Is it possible?
I would most certainly not want to be Fed chair. I have known Kevin for about 23 years. I think he's absolutely brilliant. I think he's going to be pressured, whether it's from the bond market or the equity market or the press, to maybe be a little more vocal than he has been. Everybody's talking about the reaction function, including members of the Fed, but the most quiet voice on that is Warsh himself. So it's not uncommon. In fact, it's very, very common for new Fed chairs to be tested a bit within the first few months of their tenure, sometimes by the bond market, sometimes by the equity market, sometimes by both. But then you have a day like today where, and this is more of a decision on the part of the Treasury Department to issue more short dated debt in order to buy longer dated debt to try to put some downward pressure on yield. So this is not the Fed doing this. So it's not a QE. It's maybe air quotes. Here I'm doing air quotes again too, QE, but operated by the Treasury. But it's a difficult task right now. Inflation is an ongoing problem. It is not just driven by the Iran war. It's not just driven by tariffs. It's also driven by AI. And I just think we're in a higher plane and a higher range for inflation, certainly than what we experienced during the Great Moderation era. And I think Warsh and his task forces may have their work cut out for them.
Yep. So I'll try to bring this home here in a second, Liz Ann. I wasted some of your time earlier in the broadcast, but what Liz Ann's referring to is the U.S. Treasury is going to basically, some simplified words, but refinance some long-term debt with short-term debt. It's cheaper. Long-term debt is trading below par, so it's like, well, I think my stock's undervalued. We'll Treasury some shares. So that's what she's referring to. But that obviously can go against you as well if short-term rates are go up more quickly. So how is I going to bring that back? Is there a most important? Well, I think in wrapping up that comment, we should get used to, this is a question, not a statement, but we should get used to maybe shorter term knee-jerk reactions that can right themselves quicker, and maybe be more situational or more compartmental. Is that okay to build a portfolio around, or would you be more ready for that huge systemic risk that impacts everything?
I don't think anybody should build a portfolio for a huge systemic risk, particularly if it's something black swan related. Those, by nature of being a black swan, they're inherently not forecastable.
Mhm.
And I don't ever think moves should be extreme from a tactical perspective. To me, the disciplines that are most important right now, maybe not all that exciting to talk about, but most important, are many of the traditional disciplines with a twist. So diversification across and in particular, not just within asset classes, but within cohorts and sectors as well. And then rebalancing. And what we've told a lot of our individual investors that either do it themselves or they're involved in some sort of rebalancing program, that a lot of rebalancing tends to get done based on the calendar. Well, sometimes volatility can offer the opportunity outside of those specific calendar-based moments to do a version of what we know we're all supposed to do in a very simple way with, buy low, sell high. And rebalancing is the add low, trim high, and stay in gear with those traditional disciplines, as opposed to trying to get ahead of these narrative changes, the life cycle of which has just compressed to a significant degree. And I think that's kind of the nature of the beast right now. There's so much more short-term money that has time horizons measured in nanoseconds. I think if anything, we should reinforce long-term disciplines and reasonably long-term time horizons, because that's when you do have discipline and prices connected to performance.
Yep. Well, and want you to know you're preaching to the choir, and we're
I
carrying
know.
that message. We're carrying that message as well. And maybe we've come full circle to say, yeah, don't take it back to betting and thinking you're going to know one, what's going to happen, and
Right.
two, what the reaction in the world's going to be. Stick with your disciplines and trim when you can, and add when you have some excess capital. So I think we're delivering a good message as a firm there.